I saw a very interesting interview with Christopher Whalen a couple of evenings ago. Now, Whalen is a banking and mortgage specialist who I have followed for decades. He's written numerous books. He's worked at the Federal Reserve. He's been involved in restructurings, and he basically knows the banking and mortgage industry inside out. Plus, he's a very interesting guy to listen to. A couple points that he made that are worth repeating. First of all, he doesn't see a recession coming anytime soon simply because of all the money that has been printed over the last several years due to the COVID lockdown. So any hints of recession aren't in the cards, according to Whalen. When asked about the inverted yield curve, now the inverted yield curve is when short-term rates are higher than long-term rates and is often a leading indicator of a recession to come. Now, Whalen claims that because of the changes to the banking system in 2008, 2009, the inversion in the yield curve no longer matters because of what the Federal Reserve did during this period. Now, these comments definitely merit further investigation, as I had heard nothing remotely close to the things that he was saying on this topic. But most importantly for investors were his talk about how the Federal Reserve and the government's going to deal with the huge $2 trillion plus deficit that we're going to be looking at over the next year or two in the US. And he simply said that the Federal Reserve is going to run the economy hot, meaning that they're going to have higher inflation than what we've seen in the past, specifically maybe as high as 4 or 5%. Now, Whalen claims that the Federal Reserve is likely to cut rates over the next year, maybe down to 3.5%, 4.5%, not nearly as much as the markets are expecting, because Whalen claims that when the Fed went below 3%, they really didn't get the bang for their buck that they thought they would. So going back to zero is out of the question. But if the Fed cuts to 3.5%, what he's saying is that the long end could go up quite a bit. So we're now looking at a US 5-year Treasury bill paying 4%. He thinks that could go up, 5 or 6% in a normalized curve if the Fed cuts to around 3.5%. So for investors, this means that, one, you're looking at possibly much higher inflation going forward, but you still have quite a bit of risk in the bond market, meaning the price of bonds could go down as interest rates go higher. So as that relates to what we're doing, we have shorter term bonds. We don't go out past 5 years. And in fact, we may even shorten this further going forward just to remove any risk on the interest rate curve. And it also tells me, and I think Whalen is correct on this point, that we're looking at higher inflation over the next decade, which means you have to have a hedge against inflation, which we do through gold, silver, and equities. Whalen believes that equities are very good at pricing in the inflation that's going to be seen, meaning they can adjust their pricing, their cost structure to not profit from it, but keep pace with inflation. So stocks could be a good inflation hedge going forward as well.